Okay, well, hello everyone. Welcome to today's webinar entitled Introduction to Blockchains, Bitcoin and Crypto Assets, hosted by Echoes. So my name is Tom Bailey, Head of ETF Research at HANetf. So at HANetf, we're an ETF and ETC issuer, providing alternative exposures ranging from cloud computing ETFs to uranium mining ETFs to crypto ETCs. So we're joined today on this webinar by Andre Dragos, who's the Head of Research at ETC Group, and Eamon Maguire, who's the CIO of Thinking Wealth. So the structure of this webinar will be based around a presentation from Andre, but we want to make sure it's as interactive as possible. So myself and Eamon will be asking Andre questions or giving our views along the way. And also any guests who are live and not watching the recording, you're also invited to ask questions throughout. So please type any questions or comments into the question box and we'll be sure to get to them. So before Andre starts his presentation, Eamon, I wonder if there's a few words you wanted to say.
Yes,
Thanks
sure.
very much,
Maybe Eamon, you go first.
I'll go first, Andre, and introduce you after that immediately, if that's okay. Thanks very much indeed, Tom. And hello, everybody. Welcome to the webinar. I'll give a very brief introduction to myself, and also because this particularly relates to cryptocurrencies, I'll give you my view on cryptocurrencies as well in terms of my journey in understanding of cryptocurrencies generally. I'm Eamon Maguire, and I am CIO of Thinking Wealth. We're in the process of launching a brand new investment advisory platform in Dubai and India. I've over 30 years of experience in the financial sector and primarily in the areas of governance, and I've been lucky enough to work in a number of financial sectors, including the Isle of Man, London, and Dubai. In terms of my understanding of crypto, I'll be honest with everybody in that I started off as a cynic, very much in the cynical camp, because it is essentially a new investment paradigm, and you have to understand cryptocurrency in a different way than other traditional asset classes. And I have been very guilty of looking at cryptocurrency under the lens of traditional asset classes, when perhaps this is not the right view. And I've taken the view in the past that cryptocurrencies could be really and have the hallmark of Ponzi schemes. But this is very early views, and of course, as it's scraped under the surface, I have my own emerging views. And my own emerging views are this, and I'll share these perhaps later on if there is an opportunity to do so. And if not, I'll share my theory after the webinar on LinkedIn. So my theory is this, is that money is a form of energy, and all energy must conform to the first and second laws of thermodynamics. So when you look at cryptocurrency in this realm, it shows a very, very different sort of paradigm, and perhaps gives an indication as to why we are experiencing what we are now. Because it very much relates to the first law of thermodynamics. And later, as Bitcoin is mined, I think it will change form and more correlate to the second law of thermodynamics. And therefore, then it will more become move from the realm of investment to the realm of a currency. And with having said that, if I get an opportunity to share a little bit more about that view, and it's my own emerging view, I'll do so later, but I'll hand over to Andre for the presentation, if that's okay. Thank you so much, Andre.
Thank you so much, Eamon. Yeah, very warm welcome from my side as well. My name is Andre Dragos. I'm Head of Research at ETC Group. We're the biggest Bitcoin ETP provider in Europe. We have the biggest Bitcoin ETP at the moment in the market right now in Europe, which is above 1 billion USD in assets under management. And today, this is more like an introductory webinar to blockchains, Bitcoin, and crypto assets. If you're more advanced into your journey, this is probably not so much of interest, though we will have some interesting insights for you as well. But this is supposed to be more of an introductory kind of webinar for those who want to get up to speed on what happened in the space, crypto asset space, Bitcoin, and so on. And essentially, I have 3 key takeaways in this, or 3 key messages in this analysis. So you will probably take away that Bitcoin did not come out of nowhere. There's a whole history of computer science behind it. That's first. Second is you'll probably learn that blockchains and Bitcoin have the potential to be as disruptive as the internet itself. And last but not least, talk about forecasts. We will provide some forecasts as well. We see many positive value drivers for both Bitcoin and crypto assets this year, such as the US Bitcoin ETF story, the halving, and I'll explain what it is in a second as well, and a potential US recession associated with a reversal in US monetary policy. But let's dive into the slides. I love to show this kind of stone, but just a very brief question for the audience. Who can say what this is in the audience? Maybe Eamon, Tom.
Well, we got someone from the chat. Stone money is what
It's yeah,
from the Yap Islands.
Right.
Is one of the.
So some people.
Someone in the audience knows.
Yeah, somebody in the audience knows already. Yeah, it's true. It's actually money. Yeah, and Eamon, you mentioned that money is a form of energy, and I think it's a very good example. This particular stone money, which is found on the island of Yap, it's in today's Micronesia in the Pacific Ocean. They used this kind of stone money as a medium of exchange, and you'll see that it has many parallels, or is very similar to money, tokenized money on a blockchain like Bitcoin. For instance, so this stone money was used as a medium of exchange. These kind of stones, they came in different shapes and forms. They were scattered throughout the island. And different people on the island had claims on these stones, right? They didn't belong to one person only. Different people had different claims on these stones. And whenever there was a transaction, for instance, one family wanted to buy a cow from another family on the island, what happened was the whole tribes, they convened at the center of the island and said like, okay, family A wants to buy a cow from family B. It costs such and such stones, right? This amount of stones. And before the transaction went through, every family had its own ledger of all past transactions, right? Every kind of stone, which stone belonged to which family and so on. So before the transaction went through, the family or the individual checked whether, okay, does that stone actually belong to that family, that guy? Yes, it does belong to that guy, and other families with identical ledgers had to confirm this. So there was some kind of consensus, right? Consensus had to be achieved among all those parties involved, right? And so they verified, okay, he does have this amount of stones. He can transact and he can buy this cow, right? And then after the transaction went through, they said like, okay, this stone does not belong to this family anymore. It does belong to that family. And everyone who had this kind of ledger wrote it down. So there was an identical entry across all these distributed ledgers, right? There was no single central ledger in this sense, because the alternative would have been you have one like one head of the tribe, let's say, and he had one single ledger, and you'll realize, okay, it's subject to manipulation, it's easy to manipulate, and so on. That would have been the alternative. But on that island, you had identical distributed decentralized ledgers, and the stones didn't move, just claims and liabilities were exchanged, and everybody had to agree, right? There was consensus. And this actually has many like similarities with blockchain. So Eamon, you have a question or a remark?
Yeah, sorry, Andre. Yeah, it actually goes back to my initial comment as well.
Yes.
The first law of thermodynamics, because that law states that energy cannot be created or destroyed, only transformed from one form of energy to another. So it's actually
Yes.
in the creation of the stone that the energy is being that's being transferred. So somebody's using energy to create the stone, and that in itself exerts some value to the stone.
Yes,
And little
exactly.
bit, and so it's been transformed from creative energy to create that stone to actually money energy that is applied to the stone thereafter.
Absolutely. And I think that's the big similarity to especially Bitcoin, right? And the proof of work algorithm. So that's a proof of work algorithm that is a big and important feature of the Bitcoin blockchain, which means Bitcoins come into existence. They are produced via this kind of proof of work algorithm, which means the miners that participate in validating transactions, they try to find a hash. And what they do is they need to compute trillions of combinations in order to find that hash and verify the transactions. And this is energy intensive, right? You need energy, electrical energy, you need hardware, you need time, which is also a resource, right? In order to produce Bitcoins, which is very similar to that stone money, right? And that's why you have some kind of marginal cost of production. You need to input energy, yeah, in order to create it. So this is, yeah, you also create value with this, right? And what's also similarity is, of course, the open ledger. That's very central to Bitcoin and other blockchains. Distributed ledger, which is identical copies of the ledger that includes all past transactions and therefore also the balances, right? Because you can infer all the balances from all past transactions. So it's an open ledger. It's you can, for instance, in the case of Bitcoin, you can check it online. If you have an internet connection, you can check the ledger, can check all kinds of transactions. They're semi-anonymous, meaning you see all balances, you see all transactions, but you don't know who's behind it, right? Yeah, and another big part is consensus, right? That's an important characteristic within the Bitcoin algorithm itself. You need to achieve some kind of consensus. If there's no consensus on the balance, the available balance that one party can transact, the transaction won't happen, right? And it's distributed, decentralized consensus. And this might give you some idea how blockchains actually work, in particular Bitcoin. But I mentioned at the, yes, Tom, please.
One of the audience members asks about the kind of energy and value question. So in economics, value is seen as subjective. So how does energy consumption turn into value as such?
Yes, I mean, we attribute value on a subjective basis, but that is informed by, I mean, realistic, I mean, that's informed by reality itself, right? Because if we need to invest time, if we need to invest energy, then the subjective consensus of value might be such and such, right? Because everybody knows, oh, you need time to produce gold, for instance. You need energy, resources to produce gold. It's scarce, right? That's why you achieve this kind of, maybe it's subjective, but you achieve this kind of consensus. What's the intrinsic value? It's a similar question, right? What's the intrinsic value of, for instance, a light bulb? And in most cases, it boils down to marginal cost of production, right? In a perfect competitive market, the fair value, the intrinsic value of a light bulb is the marginal cost of production, right? It will converge to this price over time. And I think in the case of Bitcoin, you can do similar kind of analyses where you say, okay, because this is somewhat digital type of commodity, right? You need energy, you need resources in order to produce it. the fair value, intrinsic value, is equal to its marginal cost of production, right? Which is probably consensus, even if it's subjective, you know. Because let's say, so the counter example would be, okay, I think Bitcoin has no value, it's zero intrinsic value. But then you say, okay, go ahead, go and buy me one, right? If it has no value, please go, and I give you $1, please go and either produce one or buy me one in the market, right? And the market reflects that consensus, right, on which is subjective value maybe, but it reflects that consensus that currently one Bitcoin is worth $45,000, right? That's just a fact, and I think it boils down to, in that case, marginal cost of production, ultimately, you know. But I think we're digressing too much. But what I mentioned at the beginning as well, in the introduction, is because most people, especially investors that I talk to, they have this kind of misconception. They think like, Bitcoin just came out of nowhere, right? 2008, Satoshi Nakamoto, the anonymous founder, Bitcoin, published this white paper, Bitcoin peer-to-peer electronic cash system, and then, yeah, it came out of nowhere. But the truth is, even the academic works that Satoshi Nakamoto cited in his 2008 paper, they date back like even at the 1950s, right, on probability theory and so on. And many of the inventions or the features that Bitcoin have been invented throughout the 1970s, 1980s, 1990s especially. And we had many actually, let's say, failed experiments before Bitcoin that were very similar to the idea of Bitcoin, like eCash, DigiCash, eGold, and so on. Liberty Reserve, that did not have quite the features to make it complete. And the innovation by Satoshi Nakamoto from a cryptographic perspective, yeah, in terms of cryptography, was that he actually solved two problems in cryptography and computer science, which were double spending problem and Byzantine generals problem. But this just to give you an idea. So there was a true innovation from a computer science perspective, and the whole public key cryptography actually developed already in the 1970s, which also Bitcoin draws upon, you know. So it didn't come out of nowhere. But that's something, there are many misconceptions about this topic especially. But let's talk about the potential that blockchains in general have. We know how disruptive the internet and World Wide Web was, right, in the early 2000s especially, and how disruptive the mobile phone especially was. So what the internet did, and especially the mobile phone, was software dematerialized information carriers like post, right? Physical post, cameras, maps, the way we consume music, newspapers, right? It dematerialized all these kind of information carriers and converted them into nowadays apps, right? But you have this kind of dematerialization, and we have a very similar phenomenon with respect to blockchains and tokenization. So Bitcoin and blockchains in general, they dematerialize value carriers like gold, real estate, and so on, and they convert them to a token, either Bitcoin or anything, you know. And it makes them, these kind of value carriers, tradable 24/7, 365. And so tokenization does not only enable this 24/7 trading, but it also, and that's very important for a very important characteristic of blockchain tokenization in general, this intermediates all the middlemen, right? the intermediaries. For instance, if you buy a house, you have the following intermediaries involved. You have real estate broker, right? You have notary/lawyer, land registry, the government that wants to deduct taxes, right? For instance, you have all these kind of middlemen intermediaries involved. And in case of, that's like a physical real estate transaction, right? In case of a tokenized real estate transaction, it's just payment versus settlement, delivery versus payment. So you pay, for instance, you have a digital pound or digital euro, right? And as a token as well on a blockchain. And you pay it to the seller of the house, right? And the moment he receives your tokenized money, digital euro, digital pound, whatever, the real estate token that actually contains the right to possess the house, to own the house, right? To have access to the house and so on, to lease it and so on, is immediately being transferred to the buyer. So no intermediary involved. And because of the public ledger, anyone can look this up and see, for instance, okay, now this house doesn't belong to party A, it does belong to party B, and so on. And this, I mean, this kind of disintermediation can be applied to anything, especially with regards to securities, because there are so many middlemen involved with respect to securities clearing and settlement on securities exchanges and so on. But yeah, the key takeaway is the Internet of Value, meaning we transfer any kind of asset via the internet, like we transfer an email, you know, are potentially as disruptive as the internet.
Andre, so just kind of tying that back to the Yap Islands example.
Yes.
So if you think of the Yap Islands as a very close-knit, small-scale community, and therefore this consensus around ownership is possible, and then with a scaled-up society, then these intermediaries or centralized kind of parties are required for determining ownership, and then the breakthrough with blockchain is the ability to do that consensus, but at scale. Is that kind of a fair way to?
Yes, at scale on a global basis, right? Because, for instance, many people say, like, especially like mainstream economists, they say like, governments will ban Bitcoin, right? They just ban it, but it's not, for instance, not possible because it's a decentralized network, right? You have full nodes computers that verify Bitcoin transactions sitting in North America, sitting in Latin America, Africa, everywhere in the world. It's decentralized. And nobody has single power to stop the system or stop you from transacting anything. What we saw, for instance, in those countries that try to ban it, to prohibit it, banning means essentially you don't ban the network. The network will still exist because it's decentralized. You can't ban the network, right? What governments or regulators usually do, they ban their citizens, their own citizens, from participating in that network. They say like, okay, you bank, you're not allowed to participate. You exchange, you're not allowed to participate. You're individual and so on. And yeah, it's on a global basis, decentralized. It can't be banned, and especially in those countries that try to ban, like Egypt, Nigeria, what you saw is, okay, exchange volumes dropped to almost zero, no official like exchanges, but peer-to-peer transactions skyrocketed to new all-time highs. You know, so it's impossible to ban it. You know,
Andre, my understanding is that, of course, blockchain is underpinned and made possible because of cryptography. And in the emerging world of quantum computing, is that cryptography at risk? So could it be that as soon as quantum computing potential is realized, that the potential of blockchain is undermined?
it's an excellent question, and the answer is probably no, because Bitcoin miners, they're not like nerdy, geeky home miners anymore. Bitcoin miners are companies. They're listed companies like Riot, Marathon in the US. And if you have been to these server farms, Bitcoin mining farms, they're huge. It's like factories. It's like warehouses of Bitcoin mining hardware. They use the top-notch, cutting-edge mining hardware, which employ 7-nanometer chips. Right, so that's the cutting-edge technology in these ASIC, so-called ASIC mining hardware, specialized Bitcoin mining hardware. So what I'm trying to say is these companies, they're usually first to adopt the newest technology to secure the network, right? Because they have an economic incentive to do so. And when they adopt this newest technology, they have higher efficiency, mining efficiency. They can compute hashes faster, right? So they will acquire a higher piece of the share of the pie, essentially, right? Of the mining revenue pie. So they have an economic incentive to always acquire the newest hardware. And the moment we have quantum computers, I assume the first to adopt this kind of technology will be Bitcoin miners itself. And so it probably won't make the blockchain or the network in general less secure. It will make it more secure.
Okay.
It's somewhat counterintuitive, but because of the fact that they're usually the first to adopt new technology, is probably they will be probably the first to buy quantum computers as well,
Yeah.
And so I don't think it's a risk. It's actually, it will probably make it even more secure, No. But before like talking specifically about any token or crypto asset blockchain, I wanted to give you just a very brief overview about what type of blockchains are there and what type of tokens, right? But in general, you can say there are 3 main types of blockchains and 3 main types of tokens. So it's very easy to memorize. And the way blockchains are actually structured is via access rights. So you have public blockchains, which are also the ones, mostly the ones that you can trade. Right? You can trade the tokens of these public blockchains, which are Bitcoin, Ethereum. They are permissionless. You don't need permission to either code or interact within these networks, right? You can transact freely. Nobody can freeze your assets and so on. Right? But there are also permission blockchains where you need some kind of access right. You need an access right to code on them. They're not like open source and you can start coding and propose anything, right? And these are, for instance, like Ripple is a permission blockchain. And they're also so-called private blockchains. They're not online. You can't really access them. You can't even see them. They don't have an open ledger. Sometimes also called enterprise blockchains. You've probably heard of this. They're employed within companies or bigger networks as well, banking networks, but they're usually not accessible to the wider public. But these are actually the main 3 types of blockchains. So public, permission, private, and they differentiate only via the access rights, And on the right-hand side, you see 3 main types of tokens, right? Payment tokens, utility tokens, and security tokens. So Bitcoin is a classic payment token, right? You can transact value over the internet. Utility token is something, as the name suggests. So, for instance, there's a coin called, or crypto asset called Filecoin. Yeah, Filecoin. You can pay Filecoin to receive storage, file storage, right? So there's some kind of utility attached to having Filecoin, right? You can get more storage, file storage. And security token is, as the name suggests, there are tokens that that have certain rights. They function like equities, but also securitized tokens are also called security tokens. Right? These are the three main types of tokens and three main types of blockchains. And let's talk about the market, because that's the interesting part, right? We will all want to invest in these products. How does the market look like? Yeah. And I like to show this kind of bar chart that compares the market caps of the major crypto assets, that is Bitcoin and Ethereum, against traditional assets like equities, bonds, real estate, and so on. And you see, I mean, 912 billion US dollars market cap is quite good. I mean, for a crypto asset, but nonetheless, in comparison to traditional assets like Apple stock, I mean, Apple stock is almost 3 trillion market cap, right? Gold is 13 trillion. And if you look at global equities, this is just like MSCI World All Country Index. It has developed countries, emerging markets. It's 88 trillion. So it's more than 88 times bigger than Bitcoin, right? And if you take the whole crypto asset market, it's 1.5 trillion. So even if you take all 20,000 tokens, yeah, more than 20,000 tokens, around 8 to 9,000 are actively traded. Even if you take the whole crypto asset market, it's just 1.5 trillion. It's a relatively small asset class, but on a positive note, that means it has so much upside potential, right? For instance, many crypto asset analysts say like, okay, Bitcoin is viewed as digital gold. You hear this kind of narrative very often. And so Bitcoin is viewed as a gold contender, right? Because I like this quote by, who said it? I think Edward Snowden said it, but it's a very good quote. He said something like, gold is Bitcoin that you can transact over the internet, right? So the beauty of Bitcoin is it is scarce as gold, but you can transact it freely over the internet. You just need an online internet connection, right? And so many experts say, okay, it has the potential to disrupt gold. And hypothetically speaking, if Bitcoin increased to a market cap like gold from 912 billion to 13.2 trillion, this would imply a token price of $600,000 per one Bitcoin, just hypothetically speaking. So there's huge upside potential, even if it were only to disrupt gold. But there are many investment cases for Bitcoin that say like all these kind of assets, like real estate, like equities, they have some kind of monetary premium, because since 1971, you have a fiat standard, right? Money has no intrinsic value, has no gold backing. And so all these assets were used as stores of value as well, right? Like real estate. And so there's an investment case to be made that there's some kind of monetary premium that could accrue to Bitcoin as a new anchor in the financial system. But maybe too far-fetched for the time being, but just like to give you an idea about how much potential there still is.
I suppose, Andre, what it does do though is make me think back about the early days of Bitcoin and make me just be glad that I didn't buy a cup of coffee with a Bitcoin. So in the early days.
Yes, or 2 pizzas for 10,000 Bitcoin, which happened.
Yeah.
Exactly. Yeah. I mean, obviously the returns in the earlier days were much higher, right? But so was volatility, right? Because there was so much uncertainty, and you have similar kind of developments in other like disruptive investment cases like Amazon, online retailing, right? If you looked at Amazon 20 years ago, Amazon stock, right? It had a drawdown of 90%, volatility of 200%. Everybody thought like selling books online is a stupid idea, you know? you had significant returns back then, of course. Nowadays, not so much anymore. But on the bright side, volatility has decreased as well, structurally, right? It's not as risky as it used to be 20 years ago. And I think you have the same kind of phase. So crypto assets and Bitcoin are in a similar phase right now. Right? There's much more uncertainty because nobody knows whether it will disrupt or like business, usual business cases and so on. Right? If it will disrupt gold or anything. So there's much more uncertainty, meaning higher volatility, but at the same time, much higher expected returns, right? There's always, these are two different sides of the same coin, right? Higher return, higher risk. I think that's the trade-off. And Andre, yeah, please go.
Andre, you know, when you talk about Bitcoin, there is a potential store of value, and you know, you compare that to gold, and you see exactly what's happened since the debasement of currencies and the fiat currencies particularly. Now, in the future, there is you know, talk and speculation that certain countries will revert to a gold-backed currency. But based on what you're saying, is it possible that countries could revert, instead of gold-backed currency, to a Bitcoin or a cryptocurrency-backed system as a store of value equivalent to that of gold?
Absolutely. I think that's, it used to be a crazy idea a couple of years back, but you see many more economists like floating this idea. But I'll pick on that later on. I have a couple of slides prepared for this particular question as well, where we compare Bitcoin versus gold versus fiat money. I think we'll explain this much better. But before we do that, I just want to show you. So we started talking about the market. How does the market look like? You saw the market cap itself of crypto assets, Bitcoin, Ethereum in particular, is still relatively small compared to traditional assets, right? And I just want to give you a brief overview how the market currently looks like, right? These are the top 20 crypto assets. You can see Bitcoin, Ethereum on top. You see on third Tether USDT, which is a stable coin. It's essentially a fiat-backed crypto assets that trades like US dollar, right? Because it exchanges one Tether USDT is supposed to exchange for exactly $1 US. But it's like a tokenized US dollar. You can transact it everywhere in the world, right? Within a simple internet connection, simple Tether wallet, right? And you see Bitcoin has a market cap of around 900 billion USD. Second is Ethereum, right? And you see the market on the right-hand side is relatively concentrated. 70% of the whole market cap is actually concentrated in Bitcoin and Ethereum, right? More than half is concentrated in Bitcoin. I mean, it's highly concentrated, it's more concentrated than the S&P 500. I think currently, what was the exact number? Top 5 stocks in the S&P 500, I think concentrate around 25% of market cap. In this case, 25, something like Nasdaq's 50% or something. Nasdaq 100, but so it's much more concentrated like the equity market, for instance, but for good reasons, right? Because we're talking about networks. You have network effects. You have kind of winner takes it all effects, and many crypto assets they have different use cases, but they're somewhat similar, right? And they're somewhat also competitors. For instance, Solana is a competitor of Ethereum. So they're somewhat you can see them as kind of like similar assets, similar investment cases. And that's why you have this huge concentration, right? But let's talk about the crypto ETP market more specifically. So this was like the market in general, but I just want to pick on like how many funds, or how much is crypto assets actually invested in funds or via funds. So what you can see here, where the total assets under management for all kinds of crypto assets, right, including Bitcoin, Ethereum, altcoins, so everything ex Bitcoin altcoins, as well as basket and thematic funds, is slightly above 50 billion US dollars, right? Bitcoin is the main chunks, even more concentrated than the crypto market itself. I think around 80% worldwide is tied in Bitcoin products only. So it's even more concentrated. What you can see also is like after COVID, the assets under management really took off, right? Before COVID, it wasn't really a big thing, but then the industry really took off. And one of the main reasons is, of course, post-COVID, you had this massive increase in money supply, right? You had these monetary and fiscal stimuli all over the world, be it in US, Europe, and so on, in reaction to the COVID crisis, COVID recession. Right? Got a huge expansion in like central bank liquidity across all kinds of central banks, but also global money supply in general, right? Used to be below 80 trillion US dollars just before COVID, and then it increased above 100 trillion, right? And this was just in a matter of years. I mean, the whole money supply accrued over the past hundreds of years, and suddenly we increased the global money supply by 25% within a matter of 2 years, right? So massive expansion in the money supply. And meanwhile, we had a reduction in the Bitcoin production rate, right? Which also occurred coincidentally in 2020. So what is this kind of graph? So this chart actually shows Bitcoin's inflation rate slash the amount of Bitcoins that is being produced per year. It's called inflation rate as well. And what you can see is it's been downward trending, right? The past 13 years. What you also see is these kind of downward spikes. These are halvings. So halvings, they occur every 4 years, every 210,000 blocks to be exact, but it's around 4 years. And it's coded into the algorithm of Bitcoin. And what happens is the production rate is reduced by half, 50%. That's why it's called halving. And now we're currently, since May 2020, when the last halving was, we have a production rate of 1.7% per year. So newly created Bitcoins, newly produced Bitcoins. And this year in April, there's another halving coming up, which is also coded into the algorithm, which will halve the current production rate. So we'll fall from 1.7% to 0.7-0.8% per annum. So it's a huge, yeah.
It was quite fortuitous in 2020 when you had the coinciding of obviously the fiscal and monetary policies response to COVID, and at the same time the halving for Bitcoin. I guess that kind of explains the two together explains that massive growth of BTC prices measured in dollars.
Yes, exactly. I think there was and you had this demand shock, monetary wise. You had this demand shock in the fiat economy, right, in the real economy, by an expansion in the money supply, while you had the supply shock in the Bitcoin market, right?
Because often it's only ever spoken about in terms of the demand aspect and the broader monetary fiscal backdrop for that price performance in 2020 for Bitcoin, but the supply aspect is often less focused on.
Yes, exactly. I think what's also interesting, like the supply is almost boring, right? It's so deterministic. nothing happens. You have these downward spikes, and then it moves sideways for the next 4 years. Then you have another downward spike, right? Super deterministic. I think what's causing cycles in the price of Bitcoin, especially, is not the supply. The supply is super deterministic. It's the demand, right? You have these business cycles, economic monetary cycles that are highly variable, highly volatile. They're influenced by monetary policy, right? Expansion, contractions of the money supply. And I think that's what's causing these cycles, right?
And you know what,
And, yes.
Andre, when you mentioned the halving cycles as well, does that mean that that they're obviously getting progressively harder to mine, but will it come to a point where they'll all be mined before it is almost too inefficient or unfeasible to mine?
So next to the halving, which is called into the algorithm, you have a hard cap, right? A limit on the overall amount of coins, which is 21 million, right? It's also hard cap coded into the algorithm. What you're referring to is at some point will become so difficult, like computational wise, I think, right? That's what you mean. Yeah. It will be hard to produce more Bitcoins, but what actually ensures that this won't happen is you have Moore's law, right? It's called Moore's law. It's a law from the semiconductor industry. It says the efficiency of computer chips doubles every 2 years, right? Yeah. So you have an efficiency gain in computer chips, right? Over every 2 years, you have a doubling. I think it was even for Bitcoin chips and ASIC chips, it was even faster. It was 18 months doubling, if you like retrospectively. But I think this kind of Moore's law actually ensures that this won't happen, because you have the halving every 4 years, but in between, yeah, more or less every 2 years, a doubling of chip efficiency, right? And so I think it's also somewhat what probably Satoshi Nakamoto also had in mind when setting these 4-year halving cycles, because he wanted for miners to adapt to this higher difficulty, right? But I think coming back to your remark, Tom, which is a very good remark, I think we have something similar coming up this year, right? To 2024, because we have 100% the supply shock in Bitcoin, right? The halving. At the same time, we'll probably have a new demand shock if there's a reversal in monetary policy. I mean, the market already expects that there will be reversal. Fed will cut rates this year. It's been postponed, and the Fed has guided markets towards later cuts, right? But let's assume we'll have a recession, and it's also our base case that we have a recession in the summer. Then you'll probably have this kind of reversal. So there might be a demand and supply shock at the same time. But I think
is there also a second demand shock in the form of increased demand via the approval of Bitcoin ETFs in the US?
Absolutely.
We had a question from the audience on what the BlackRock Bitcoin ETF, what the impact will be. So I thought I'd just tie that in, if that also.
Yeah, it's a very good question. I'll have a slide prepared on that as well.
Okay, we'll come
for the forecast. I'll keep that in mind, and yeah, we'll talk about this in a couple of minutes. But coming back to the supply shock, what's also really interesting, and that's new for Bitcoin as well, and it will be completely new for the whole investment community, is that for the first time, Bitcoin will be more scarce than gold this year, because there's a concept called stock to flow ratio. Maybe you've come across this in the commodity space. The stock to flow ratio is actually an indicator for scarcity in the commodity space. The higher this ratio, the scarcer a commodity is. Yeah, for gold. So what stock to flow does is stock is all the supply of a commodity above ground supply, all the gold stock in the world that has been mined, divided by its annual production, right? So in the case of gold, it takes around 60 years to replicate the current supply that is in circulation. 60 years of annual production. In the case of Bitcoin, it takes between 49, 50 to 60. It's variable still, but it's around 50 to 60 at the moment. It says here 49, that was 2020, but it's almost similar to gold right now. That's what I'm trying to say. But this year, with the halving, the stock to flow ratio for Bitcoin will double to 124 years, meaning it will take 124 years of current Bitcoin mining / production to replicate the current supply of Bitcoins, which is 19.5 million coins at the moment. But this won't happen either because we have a hard cap of 21 million, so it can't even double. So because we have absolute scarcity, right? And so I think that will be really interesting to watch. And I think this bar chart also shows that the character of Bitcoin has been changing as well, you know. Maybe it didn't used to be such a scarce commodity in the early days, right? But with every halving and increasing scarcity, as it has become more gold-like. You can make that case because I mentioned Amazon stock with the decrease in volatility over time, right? It's same for Bitcoin. You had around 200, 300% volatility, you know, in the early days of Bitcoin. That has decreased to 40, 50% right now, and will probably continue to decrease with every halving, with increase in scarcity. So it used to be a super high risk asset, but that character has been changing. It's now converging towards a more safe asset, you know. That's why I think there's also this misconception, oh, Bitcoin, CryptoAssets is super risky. But I think because the algorithm dictates somewhat these kind of increasing scarcity and so on, the character of this asset class is actually changing, especially Bitcoin, you know, over time. Yeah, and it's not only a very elegant model. You can use this actually to make forecasts, you know. For instance, based on that stock to flow, you see a very close link, high correlation, supply scarcity and the price of Bitcoin, right?
Andre,
And yeah. Yes, please.
You think the current price factors in the imminent halving event in the moment?
Because public information, you mean?
Yeah.
Yeah, it's a question we get many times, and the answer is it cannot be priced in advance, though it's public information. The reason is that the moment it's being anticipated and the price picks up, miners start selling more Bitcoins. They start selling into their reserves. And they can't do that after the halving because no matter how they increase their computational power, they will only mine so now they're mining 900 Bitcoins per day approximately. After the halving, no matter how they increase their computational power, they will only mine 450 Bitcoins, halving, right, per day. Because that's also the beauty of Bitcoins. The algorithm is that there's a so-called difficulty adjustment. When they increase their computational power, they won't mine more Bitcoin. The supply is completely price inelastic. Right. So it's very interesting, also very important part of the algorithm. But yeah, coming back to this model, so there is a close link between scarcity and the price of Bitcoin. And we'll come to the more particular forecasts later on as well. But there was a question between Bitcoin, gold, fiat. And this is just like a simple comparison between Bitcoin, gold, fiat monies like the US dollar, and so on. But don't focus too much on that table. I just want to pick your brains on what's the innovation of Bitcoin, right? Compared to gold, compared to fiat monies, right? Because we use fiat monies like the dollar, or I think in UAE use dirham, or India use rupees, we use euros or pounds, right? So we have medium of exchange, right? We have payment providers like PayPal. We can do instant payment as well. So what's the use case of Bitcoin, right? The use case and innovation of Bitcoin is that it combines the characteristics of gold, which is a store of value that you can't easily transact, right, in a physical form, and the transferability of fiat monies. You just combine it with Bitcoin, because you can send Bitcoin over the internet, right, globally, and it can actually, you can store your wealth in it like gold, because the thing with fiat monies is, and especially in developing countries like Argentina right now, or Lebanon, that have high inflation rates, is fiat money is being diluted at a very fast pace, right? You lose purchasing power over time. It doesn't have intrinsic value. It's created out of nothing. There's no anchor, right? There used to be an anchor in 1971 and before that, right? But not anymore. So it's created out of nothing in the commercial and central banking sector. And that's I think that's the innovation of Bitcoin. You have something that is digital, that is as transferable as fiat money, but actually you can store your wealth in it. So it's a combination, the best of two worlds, exactly, right? Fiat monies and gold. And that's the innovation. And you'll see that, for instance, especially with respect to scarcity. So I mentioned 21 million coins hard cap on Bitcoin. Fiat monies are theoretically unlimited. The process of money production is completely intransparent. I mean, you can check the data ex post, but you have no idea how it's going to develop. You know exactly how Bitcoin supply is going to develop over time, because it's hard coded in the algorithm. Every 10 minutes you have 6.25 Bitcoins. It will halve to 3.125, and this will continue for the next 4 years and so on. So it's hard coded in the algorithm. You can check the supply, right? Fiat money's expansion and contraction is decided, I don't know, behind closed doors, essentially, right? Within the central bank, right? At the FOMC or anywhere. Plus, yeah, I think reliability, that's the big point with fiat monies. Of course, easy to transfer, which gold is not, transferability. And yeah, bottom line, I think, and there was a question on this as well, the difference, right? Bitcoin, gold. What was the question again, Tom? I think you mentioned a question from the audience.
I don't think there was a question on that necessarily on Bitcoin versus gold, no, but I'm sure it's relevant to speak to.
Yeah.
And I suppose as well, Andre, gold in terms of security can be stolen as well. Whereas there's a Bitcoin, as to my knowledge, been very, very secure in terms of cryptography. I'm not sure, and it hasn't been broken, so it is very secure.
Yes, the reason is that because of proof of work, you need to use resources, energy, hardware, time, etc., in order to break it. You can theoretically break Bitcoin by acquiring more than 50% of the computational power of the network. Then you can compromise the network. But compromising the network is costly, So you at least you don't have an economic incentive to compromise the network, Only governments could do this, but it's also impossible right now because the way Bitcoin mining hardware, the industry is structured, it takes so much lead time to acquire a huge chunk of the hardware itself. You know, because chips are scarce. You know, you have supply chain issues essentially. You can't acquire, like, you need at least, I have done some estimation, you need at least 30 billion to 40 billion in hardware investments, really, US dollars, 30 to 40 billion in Bitcoin mining hardware investments to compromise the network. Governments might have an incentive. For instance, the US government might think, okay, this could be a threat. We'll invest in these kind of hardwares. But it's impossible because you can't order so many machines, you know, at once. There's a lead time in production, chip manufacturing, and so on. It's practically impossible, you know. Yeah. But yeah, I think we've talked so much about Bitcoin, but of course, crypto assets are so much more than just Bitcoin, digital assets in general. So you have a large variety of investment opportunities. We talked a lot about digital gold, but of course we have, like, the second biggest crypto asset is Ethereum, right? And it's not similar to digital gold. It has similar properties with deflationary supply and so on. It's limited and so on. But it's more akin to a decentralized applications platform, right? And you have other blockchains where you have decentralized financial services and, of course, digital art. If you came across these NFTs, non-fungible tokens, they're also enabled via blockchain technology. So there's so much more to crypto assets, blockchains, than just digital gold. We just picked on on the biggest asset, but nonetheless, it's just a part of the whole ecosystem. But let's talk about forecasts. So you
Andre, just to let you know,
on ETFs, right?
Yeah, Andre, just so you know, we've come to about 5:30, but we think we'll go overrun by 10 minutes or so.
Yeah, I think if the audience wants to stay, we'll continue.
Yeah.
I think, yes. Will there be a recording of this? Then yes, then probably you can send around the recording for those that have another meeting.
Yeah.
But yeah, we can continue, and we can also do the Q&A after this. So talking about forecast, I think we have 3 very important scenario catalysts for this year, 2024. I think this one is actually already done, right? Bitcoin ETF approval, the US spot Bitcoin ETFs have been approved by the SEC on 10th of January. So we can check mark this. Ethereum ETF approvals are coming up. There's a final deadline for the SEC on 23rd of May, where they need to decide on one of the products. So you may have a similar story playing out for Ethereum. But another very important catalyst is the Bitcoin halving. We mentioned it previously. You have that cut in production rate by 50%, also very important. And I'll show you the implications in a minute. And last but not least, likely US recession and reversal in monetary policy. Pivot, proverbial pivot. That's also an important driver. That check is the check mark. And wildcard, maybe some geopolitical risk, and we can talk about this as well. But let's talk about the potential impact from the demand side. I think you touched on this briefly as well. You mentioned it, Tom. I think that was the question from the audience as well.
Yeah.
So we did some estimations on the potential effect on the price of Bitcoin, and this is just a tiny excerpt of this analysis. So the way we approached this is we looked at the ETF market in the US in general. So how does the ETF in the US alone look? ETF market in the US look like? And around $6 trillion are tied into risky asset ETFs, such as equity ETFs. And we assumed of these 6 trillion in risky assets ETFs, 20% of those investors may decide, I might invest some of my portfolio into Bitcoin, right? Into these new spot Bitcoin ETFs. And let's assume they invest around 3%. So 20%, 1/5, every fifth investor says like, okay, I'll substitute some of my investments and I will substitute around 3%, right? So if you multiply, let's say 6 trillion with 20% times 3%, you come up with a number of $36 billion. And we can talk about whether these kind of assumptions are realistic. And we thought this would be realistic, like because the adoption rate in the US is around 20%. Some statistics say 16%, some newer surveys say 25%. So 20% is quite realistic, and 3% is usually the middle between what is also recommended in terms of portfolio allocation. I think the usual recommendation is between 1% and 5%, right? So this make quite a lot of sense, these assumptions. And just to give you an idea about this number, $36 billion is around 90% of global Bitcoin assets under management. So it's quite large. You know, with these new investment flows into Bitcoin spot ETFs, the whole global Bitcoin fund ETP market would potentially double, you know. And what does this mean for the price? So what we also did was like, what's the sensitivity of Bitcoin's performance to global Bitcoin ETP flows? And we did this kind of statistical analysis, and the sensitivity is on average, like full sample analysis is 0.98. So for every 1% increase in global Bitcoin AUMs, you have a 0.98 percentage points increase in the price of Bitcoin. And so you can say, okay, it's almost 1-to-1 relationship. So if this like 87% increase in global Bitcoin AUMs, you can assume, and this is rather conservative, you can assume 87% performance just via these medium-term flows, you know, over time. And I say conservative because we also looked at how does this multiplier change over time? Because not always 0.98, you know, it's not always 1-to-1. Sometimes it's as high as 10, you know, 10x multiplier. In the past 6 months, that multiplier was around 7. So that's still quite conservative. I think some competitors like CoinShares, they have very much higher sensitivities that they've published right now. So we are still conservative with these 87% increase. Talking about the next or the second biggest scenario catalyst, which is the halving. But what's the halving anyway, right? Talked about this. The halving is like a supply shock, right? So today you have around 1.2 billion Bitcoins that is being mined per month in US dollar terms. Let's assume demand is the same. So we have an equilibrium price, equilibrium demand and supply. But in April, this will, it will drop by half. It will drop to 626 million US dollars, while demand presumably stays the same, right? So you have some kind of supply shock. And what the market does is it usually finds a higher equilibrium price. You know, it adapts to this slower production. It usually increases. That's at least what happened in the past. So this is an analysis around all past halving events. So days around halving, minus 400 days, plus minus 500 days, plus 500 days after the halving. And this is the halving event in 2012, 2016, 2020. And this is like the mean performance, median performance, and the min and max values. And what you can see is it increased significantly after these halvings, right?
Andre, you mentioned a mechanism whereby, you know, the halvings, the foreknowledge of the halving isn't necessarily priced in.
Yes, exactly.
But I'm just in terms of thinking of, say, the approval of Bitcoin ETFs in the US and increased institutional adoption, the effect that had on, say, equity markets in kind of making them much more efficient and incorporating new information quicker and making the market more efficient. Will potentially the post halving upside diminish over time as you have kind of more a larger investor base, better access tools such as ETFs, and also increased institutionalization?
I think it's a good question. I think the marginal effect of those halvings will decrease, and I'll show you an example of that in a minute. But I also think on the bright side, increasing adoption will lead to less volatility because you have more dissent. If you have more diverging views, you have it's more likely that you have a buyer and seller at the same time, right? You need to have a buyer and seller at the same time for a transaction. So if you have more diverse or heterogeneous investors, will lead to less volatility, which is positive, you know, from an adoption side. But let's talk about the effect of the halvings, just real quick. So after 500 days, that's the average mean performance after the past 3 halvings was 17x. Quite a high number, meaning 1,800%. 500 days after the halving, 17x, and it was as high as 34x. That's the peak here. So it's quite significant. And the question is always, and I get this question a lot by investors, they say like, Andre, how come that every halving over the next decades is public information and it's not priced in? I can't get my head around this. It's impossible, you know. And I say like, okay, we did the math actually. We ran the numbers, and the idea was to like, if there was no significant of the halvings whatsoever, then there shouldn't be a significant performance difference between 50 days after the halving and 50 days before the halving, 100 days after the halving, 100 days before the halving, and so on. And what we found out was the halving doesn't become significant around 50 days after the halving. It does become super significant, starts to become super significant 100 days after the halving, because you have this kind of cumulative supply shock. At first, it's just a deficit of 450 Bitcoins in April, right? But then next day, it will be 900 days deficit. Subsequent day will be 1,350 Bitcoins deficit, and so on. So it will accumulate over time, this kind of deficit, this kind of supply shock, which is why you see that effect playing out only later on, around 100 days after the halving. But then it becomes super significant and the price takes off, you know. And you get the highest effect around 400 days after each halving. This is also what we expect, like for this cycle. We expect that price starts to react on the halving in April around summer and then takes off into 2025. And will probably peak in 2025, you know, which is also our expectation. For this year, we estimated based on like increasing scarcity and the halving, we estimated around $100,000 by the end of this year. And speaking of like the effect of those halving, we also incorporated the fact that the marginal effect of those halvings will diminish over time. So it's not always same effect, because in the earlier days you didn't have much of supply, and yet the halving effect was huge, right? Because initially we had a block subsidy of 50 Bitcoins every 10 minutes, and that decreased to 25. Right, the deficit was way higher, you know, than now. But even considering that this effect will actually diminish over time, we still estimate $103,000 to be exact this year. And by 2028, we estimate 215,000 for this halving period. Yeah, but talk about the third biggest and most important scenario catalyst for this year is probably US recession. So our base case is still that we'll have a recession around summer based on this kind of model. It's also a model used by the New York Fed. They look at term structure of interest rates. And it's very reliable because usually these term structure of interest rate, they have a long lead, economic lead. And it peaked for June 2024. So we think around summer is quite likely that we have a US recession. And how is this relevant for Bitcoin? So an important observation is whenever you had these turnarounds in monetary policy, you also had a turnaround, a reversal in market-based inflation expectations. I emphasize market-based because it's not like the CPI inflation rate. That's like backward-looking data. Right? What I mean is because Bitcoin is a traded asset, it builds expectations about the future. So you also have to compare it to assets that are traded that also incorporate expectations about the future, and CPI swap rates are one of these expectations about future inflation, CPI inflation in the US. And yeah, bottom line from this chart here is these are like US 5-year CPI swap rates, market-based inflation expectations. The announcement alone was sufficient for a turnaround in these expectations. They didn't start buying bonds or anything, at this point in time. They just announced they will buy. And so that was sufficient enough for like a reversal. And the moment you'll see that the Fed says like, okay, we'll cut interest rates, we'll buy bonds again. We do QE, quantitative easing, and so on. The moment they just announce it, you'd see a takeoff or a reversal in inflation expectations. And the reason why that is relevant for Bitcoin is this chart here on the right-hand side. So Bitcoin in the earlier days, like before November 2012, for instance, it wasn't so much sensitive to US inflation expectations, US CPI swap rates, because this is a plot of US CPI swap rates and Bitcoin. And there was like, slight positive correlation, but it was more or less erratic. But since COVID, it has really become highly correlated, positively correlated. And we think, or that's at least our expectation, with the next halving this year, it will become even more sensitive to inflation expectation because it will become even more scarce, right? Higher scarcity. And so if we have a turnaround in inflation expectations, this will probably be a tailwind for Bitcoin as well as a scarce asset. And many people say, like, in the context of inflation, they say like, oh, look, Andre, I think Bitcoin is not a good inflation hedge. The moment we had to pick up in inflation, Bitcoin dumped, sold off. But actually that price action that you saw in Bitcoin, especially 2022, was completely consistent with what inflation expectations did, which also decreased, right? After the Ukraine invasion of February 2020, they decreased as well because we were heading for a recession and so on. We had tightening in monetary policy, right? In reaction to that increase in backward-looking CPI inflation rate, right? And so that was completely consistent. That was also the reason why equity sold off, bonds sold off. It was not because inflation was running hard. It was because central banks started tightening monetary policy. And inflation expectations already declined in anticipation of tighter monetary policy. So it was completely consistent with what Bitcoin did. So Bitcoin is not exactly an inflation hedge. If you look at CPI, over the long term, it will outperform CPI. But it's more correlated to market-based inflation expectations, right? Yeah, but last but not least, I just touched upon it briefly. Question, and I think if you follow the news, geopolitical risks are clearly rising, be it Middle East or anywhere. And that's also a question we get asked a lot by investors: is Bitcoin hedged against geopolitical risks? And what we can say is, based on a quantitative analysis of geopolitical risk events, so we looked at around 100 of these geopolitical risk events whenever there was some kind of either terrorist attack or some kind of armed conflict popping up. So the performance of Bitcoin is it usually tends to sell off. It behaves like a risk-off asset into these geopolitical risk events. But then it recovers sharply. So the moment you have this event, it starts recovering sharply. So it sells off around 7% into these geopolitical risk events, but after 100 days, it's 15% higher on average. So it's not a clear hedge against geopolitical risks, but you can, but it recovers sharply. You know, that's the key takeaway.
I've seen some data suggesting that at least using data up to 2020, so not necessarily the best, but that Bitcoin was also better correlated around, say, US political risk than geopolitical risk in terms of that instability or questions around stability in the US itself, which I guess maybe reflects the actors in the market in terms of the US consumer is the dominant buyer of Bitcoin, and if those risks are more keenly felt. But obviously, with still a relatively new asset class, you know, coming up to 2 decades in a few years' time, but it's still going to establish these correlations over that time period. Because when you look at, say, correlations of gold or bonds or equities or property, you have that 100-year time set. So you know, these correlations will emerge, and you'll see, like you've shown there, they're starting to kind of put in place, but over time we'll kind of see them fully fleshed out, I suppose.
Yes, I think so too. And there are many indices, right? Risk indices. I think there's this like economic policy uncertainty index. But all of these indices, they have in common that they're news-based indices. What they do is they just count stories on, for instance, economic uncertainty, or count stories on news stories on geopolitical risk events. So they're still very much correlated, you know. Even if you look like you compare US uncertainty indices to European ones, very much correlated, because the newspapers, they write about the same stuff mostly, most of the time, you know. That's why you see similar spikes, you know, in these indices. Yeah, but I think this wraps it up. I just want to give the 3 key takeaways from the analysis again, or from the presentation. I think you probably learned that Bitcoin did not come out of nowhere, right? There's a whole history of computer science behind it. That's what we mentioned at the very first beginning. Secondly, blockchains and Bitcoin have the potential to be as disruptive as the internet. And I've shown you that kind of interesting diagram as well. And last but not least, we see many positive value drivers for Bitcoin crypto assets this year, such as the Bitcoin ETF story, the halving, we talked about this in detail, and potential US recession and reversal in monetary policy. And with that being said, I hope you're still there.
Yeah.
And if you have questions, I'm happy to answer them.
Andre, just one question from me, really, and started off as a cynic, you know, and a little bit of skeptical about Bitcoin. So you've really helped me in my understanding of it. So thank you. So if I want to buy Bitcoin, wow, and I've moved to that mind frame now, a mindset, potentially buying it. How should it go about buying it? And are there any red flags in terms of which to you know, that would to be aware of in terms of cryptocurrency opportunities out there?
So there are actually two questions, right? Where to buy them? So I think for retail, but especially also institutional investors, the easiest way is to buy securitized crypto assets that are 100% physically replicated, right? And of course, we offer them at ETC Group. We have a whole suite. I mentioned at the beginning of the presentation that we're the biggest European Bitcoin ETP issuer. Our Bitcoin ETP has around above $1 billion assets under management. But well, of course, we have other crypto asset offerings. But that's, I think, the easiest and most convenient way, because you trade crypto assets like a stock. In your brokerage account, you can just buy it as like a security asset, as an ISIN. It's as easily tradable. And now to your second question, red flags in terms of crypto assets. I think the top 20, let's say top 50, are more or less safe to invest in, and they have a high market cap. The top 20 crypto assets all have market caps in excess of $1 billion US. They're quite liquid as well. Bitcoin is highly liquid, has billions of dollars of trading volume per day. But I'd say apart from this, outside of these top 20, top 50, either you need to do a lot of due diligence into these projects, or you just ignore them completely, because many of those coins are either Me Too coins, Me Too crypto assets that just try to replicate what the top 20, top 50 do anyway. And you seldomly find like real new, fresh use cases, that have new potential, investment potential. So my recommendation would be stick to the top 20, top 50 max. Try to look for investment opportunities there. They're established, right? They're more established, which means they have less potential, but at the same time, they're safer, essentially.
Just on the question of access and the use of ETPs, exchange traded products. So because there's some confusion around there so the big news this year was the approval of Bitcoin ETFs in the United States. For several years, 5 years, there's been Bitcoin, what are called ETCs within Europe, which essentially are the same as an ETF in how they function. As Andre said, they trade on exchange. We have ETC Group has one BTCE, which we work with them on, and these are very similar in structure to what got approved in the US. It's just basically a regulatory difference in how you can label them. So essentially, in Europe, you can't call something an ETF unless it's adheres to the UCITS regulation, which essentially means you can't have an ETF which has only a single asset exposure. So if you were to buy what you imagine to be a gold ETF within Europe, you're actually buying a gold ETC. And it's the same with Bitcoin ETFs. You're not buying Bitcoin ETF in Europe or from a European issuer, you're buying an ETC. And that's really the only difference. But obviously with the US being such a big market, we got this kind of idea of the world's first spot price Bitcoin ETF. The difference is one letter and some slight differences on structure. But the basics of an exchange traded product, which covers both ETCs and ETFs, they've been around in Europe for several years with ETC groups, BTC being the by far the largest, actually. The second two largest account for less than the whole assets of BTC. So Andre's company C Group has the market leader there.
Yes, it's worth pointing out. That's true. There's actually no big difference. Maybe perhaps just the way shares are redeemed and created, right? We have in-kind creation redemption with the ETPs, and we have cash creation redemption with the ETFs in the US, which implies that the tracking is actually worse for the US products than for the European products.
Yeah.
And there's some, I think, more disadvantages for the US products than for the European products from a structural perspective, right? How they're being structured and so on.
Yeah. Actually, someone has just asked about does BTC offer in-kind redemption creation?
Yes.
As you said, yeah, they do. It does do
So-
in kind. Whereas the ETFs in the US have to do cash creates. BlackRock has to go out and buy the Bitcoin from Coinbase or one of the other exchanges in the prospectus at the end of the day, rather than receiving the coins themselves as BTC does. And then there's the other disadvantage too of the US products, which the market makers in the US are not allowed to hold physical Bitcoin, so they're using the futures to hedge themselves, which again adds extra cost and efficiencies to the whole process.
And what's also interesting and very important, I mean, we have blockchain technologies. It offers so much transparency in terms of holdings. Many of these US issuers, right, even the prime ones, they don't show their holdings, right, on chain, because I mean, you should supposed to be or supposed to track what's in the ETF on the blockchain itself. You should be able to verify if the coins are actually in possession of, let's say, Fidelity or BlackRock and so on. Some US issuers have done this. I think Bitwise have done this, but the majority hasn't done this. And we're at ETC Group. We show the exact wallet addresses where the coins are being stored on chain, so you can transparently look into the wallet addresses, track like whether the coins are there and so on. We do this for the BTC, but also the Ethereum product itself. I mean, what's the whole point in using blockchain if you don't make use of the transparency that it offers, right? And so I think that's also a competitive advantage that we have in Europe, especially we at ETC Group, compared to US products. Yeah, but
Okay.
are there any more questions maybe?
No.
Audience?
Okay. Shall we leave it there then?
Yeah.
Thanks to Andre, and thanks to Arvind and Eamon for organizing this, and everyone at Echoes and Thinking Wealth. If you want to find out any more, ETC Group's website is full of regular updates of Andre's research, so you can keep track of that, see what he thinks is going on in the latest developments in the crypto markets. Or you can head to HANetf.com as well, where we publish a report written by Andre and his team every month as well on digital assets. So with that, thanks to the audience, and thanks again to Echoes and Arvind and the whole team for organizing.
I think we have one last guest question. Oh no.
Thank you.
All right. Thank you very much.
Cheers, guys.
Cheers, guys. Bye.